Okay, so today, inshallah, we will have measuring and reporting financial performance. This is chapter 3 in the accounting part of the course, and chapter 3 is related to the income statement. Measuring and reporting financial performance through the financial statement, which called the income statement. So as you can see in the presentation, this is the learning outcome. We will discuss the nature and the purpose of income statement and prepare an income statement from relevant financial information and interpret the information that it contains. Also, we will discuss the main recognition and measurement issues that must be considered when preparing the income statement. I think we will not go through this part because it's not included in the course calendar, or we can discuss it just briefly. Also, we will explain the main accounting conventions underpinning the income statement. So also in this chapter we will have what we call it the depreciation of the in the accounting. There is a concept called depreciation. We will go through this concept and have one example about the depreciation. Okay, so what's income statement? Income statement is one of the most important financial statements, as I said before. And if you remember last lecture, we discussed the balance sheet, and we said that we can measure and analyze the position, the financial position of the organization, okay, through the balance sheet. And we said at that time that some of the countries call it the financial position statement or statement of financial position, and other countries call it the balance sheet. Okay, and we agree that most of the organizations here in Saudi Arabia and I think in the Gulf region use the second name, which is the balance sheet. Okay, and we said that the balance sheet is responsible to measure the position or the financial information at a certain point in time. Like, for example, at the beginning of the year or at the end of the year, we measure the financial position. But here in the income statement, we are talking about a period of time. So that means we are talking, like, for example, for a month or a quarter or a year sometimes. It's based on the preparation or on the policies and procedures that are followed in the organization. For example, some of the organizations prepare income statement in monthly basis. Okay, so every month they prepare the income statement, and some of the organizations prepare the income statement each quarter. Okay, we call it the quarterly based income statement. And also another organizations, or sometimes most of the organizations, or all of the organizations try to make the balance sheet every year, because as you know that the financial year, or as we call it the fiscal year, is something that begins in a month, in the beginning of January 1, for example, 2013, and ends at 31 of December 2013. That means this is 1 year. We call this year, we call it the fiscal year, or the financial year, as they call it. So at the end of the year, okay, at the end of each year, we prepare the income statement to see exactly how much we gain, how much we have profit, or sometimes how much we lost. Okay, sometimes we lost in the business, and that's because, for example, some of the organizations have more cost than the revenue. Overall, we can calculate the profit or we calculate the loss, which is exists in the income statement. We can calculate it by this equation that we can see here. Okay, total profit or loss is equal to total revenue for the period. Like for example, this is 1 month or 1 year or 3 months or so on. Okay, total revenue for the period minus total expenses in the same period. As an example, if we have, for example, 1,000 Saudi riyals as revenue at the end of the year, okay, and we have like 800 riyals revenue. We have 800 riyals as expenses. So how much will be the profit? For sure, the profit will be exactly, for sure, the profit will be 200, which is 1,000 minus 800 is equal to 200. This is our profit. Okay, so the profit or loss is equal to total revenue minus total expenses. This is an example of the Arsenal Football Club. The revenue for Arsenal Football Club for the year ended 31 of May 2010. As you can see here, that the Arsenal Football Club fiscal year ends in 31 of May 2010. That means not all of the organizations begin in 1st of January and end at 31st of December. Some of the companies begin at the middle of the year and ends at the middle of the next year. Okay, it depends on the accounting policies of the organization, it depends on the management of the organization, it depends on the start of their work, start of the company. So anyhow, at the end of the year, okay, Arsenal revenue was distributed in this class. For example, they have 41% from the property development, and property development, for example, like renting their facilities. If they have clubs or if they have, like for example, facilities, they develop these facilities and try to rent it. 25% of the revenue was from the gate and other match day revenues. That means from the tickets of the match. Okay, they gain 25% of their revenue. 8% from the commercial. For example, if they have agreements with some companies to put their logo on the T-shirt. If you know that if you know sometimes that T-shirts which we can find in the market have logo of Arsenal. This logo is rented by Arsenal Football Club to those companies, to other companies, to make some revenue or to increase the revenue of the club. Okay, and 22% from the broadcasting. Like for example, if they have there is match They can rent also the football match, give it to some companies to promote their products and services during the match, and so on. Okay, so this is the breakdown for the revenue of Arsenal Football Club. This is just an example. Okay, what is the relationship between the income statement and the statement of financial position, or what we call it the balance sheet? What is the relationship between them? As we can see here in the balance sheet, as we saw before in the previous lecture, this is the accounting equation, which is assets is equal to equity plus or minus profit or loss plus liabilities. Okay, this is, we saw it before. Okay, then the profit or loss here, we can break it down into sales revenue minus expenses. So by breaking this down, breaking the profit or breaking this part, breaking it down, we can find that the sales revenue minus expenses is equal to profit or loss. Okay, so here the sales revenue and expenses are two common terms exist in the income statement. So this is the relationship. In the balance sheet we have the profit and loss, or profit or loss, and the profit or loss can be found by finding the sales revenue minus expenses. We will get the profit or loss. Okay, this is the layout of the income statement. Each income statement has these parts. And this is, by the way, this is one of the most important topics or subjects here in this chapter, is that we should know exactly what are the terms or what are the components exist in the income statement. First of all, we have the revenue, and the revenue can be sales or renting or subscription fees or anything that the company get their primary income from. Here we can call it sales revenue. Okay, we find sales revenue by as we discussed this issue before, that we have this exists in the accounting system of the organization, because accounting department document each transaction, each financial transaction done in the department. So revenue or sales are some of the transactions, some of the financial transactions that registered or documented in the accounting system. So this is the revenue. Okay, when we subtract or when we remove the cost of sales from the revenue, we get what we call the gross profit. Okay, we find the gross profit. So sales revenue minus cost of sales is equal to gross profit. Okay, this gross profit is not the net profit. There is some differences between gross profit and net profit. Because gross profit is only can be found by removing the cost of sales from the revenue. But after removing the cost of sales from revenue, also we have another expenses. And we should remove those expenses from the gross profit in order to find the net profit for the period, which is the net profit. Okay, so this is the first part of the income statement. This is the first part of income statement. The first part is to find the gross profit. How can we find the gross profit? By subtracting or removing cost of sales from the sales revenue. Okay, after we get the gross profit, we need to also to remove the operating expenses. Operating expenses, those are like for example the salaries of the employees, like the marketing expenses, like the rent of buildings, expenses of cars, like fuel and so on, and repairing the cars and so on. All of the expenses, all of the operating expenses, we put it here in this part, which is the operating expenses. When we remove operating expenses from gross profit, we get what we call the operating profit. Okay, so that means operating profit is equal to gross profit minus operating expenses. Okay, and still we did not finish yet. Now we have the operating profit. The operating profit is the net profit, but we did not remove the tax or zakat or depreciation from it. So these are the items that exist in the income statement. This is what we call it the layout of income statement. Okay? The most important things here that the sales revenue minus cost is equal to gross profit, and gross profit minus operating expenses will give us the operating profit. And the operating profit, sometimes we need to pay some interest, okay, and we need to, for example, get some interest. For example, if we have investment, and this investment gives us like 10,000 Saudi riyals as interest, then we need also to include it here, and then we get finally the profit for the period, or the net profit for the period. Okay, this is an example of the income statement for the company called Better Price Store. This is the income statement for the year ended 31 October 2011. Again, this year is not at the end of the year, usual year. This year ends in 31st of October 2011. Okay, as you can see here, we have the sales revenue, 232,000. This is the revenue, the sales revenue, and the cost of sales was 154,000. That means the gross profit will be 78,000. Okay, 78,000. 232,000 minus 154,000 is equal to 78,000. Okay, we have some operating expenses like the salaries and wages with 24,500, rent and rates 14,200, and heat and light. This is the, for example, the shop heat and light. 7,500, and telephone and postage 1,200, insurance 1,000, and we have also motors vehicle running expenses 3,400, depreciation 1,000, depreciation also 600. So all of these we can call them operating expenses. All of these, from the salaries and wages until the depreciation of motor van. These are all, we can call it the operating expenses. Sometimes the depreciation deducted from the operating profit after we get the operating profit. That means sometimes we count or we calculate operating profit until here, until this level. And after that, we subtract or we deduct the depreciation from the operating profit along with the interest payable. Okay, interest payable. And then after that, we add interest receivable and get finally the net profit for the year. How can we calculate the gross profit? Simply by deducting the cost of sales from the sales revenue. Sometimes they will not give you the cost of sales directly. They give you only opening inventories or opening accounts, okay, and goods bought during the period and the closing account or closing inventory. And you should know that you can, by these three items, you can calculate the cost of sales. For example, here in the opening inventories, this is the inventories of the beginning of the year. If you have a company and this company has a warehouse, the inventory that exists in the warehouse at the beginning of the year, we call it opening inventories. Okay, and this inventory, for example, the value of this inventory at the beginning of the year was 40,000. Okay, and during the year, from the beginning of the year until the end of the year, you bought new inventories. That means you bought new products. You bought new products by 189,000. So that means at the end of the year, your inventory will be this one, 40,000 plus this one. Okay, right? Okay, but you know that during the year also you are selling some products. You are selling some products to the customers. That means the inventory is not will not be 40,000 plus 189,000. It will not be something else. Like for example, here the closing inventory is 75,000. So that means what's the cost of sales? How many items you sold during the year? How many items you sold, or how much you sold during the year? You add opening inventory with goods bought and deduct the closing inventory from them. It will be how much? 154, because you know that 40,000 plus 189 is equal to 9, this is 2, and here 1, 2. That means 229. 229 minus 75,000. 229 minus 75,000 is equal to 154,000. This is the cost of sales. This is the cost of sales. Okay, now how can we calculate the gross profit? By deducting the cost of sales, which is 155,000, minus the sales revenue, which is 232,000. We will get 78,000, and this is 78,000 will be the gross profit.